Welcome back to the Deep Dive. We're here to cut through the noise, take that flood of corporate info, and, well, boil it down to what really matters for you. Today, we're jumping into JPMorgan Chase. Specifically, their Q3 2025 earnings, and even more specifically, we're focusing just on those initial prepared remarks from the CFO.
Right.
Our mission, as always, is pretty sharp. Get past the raw numbers, really distill the big picture firm-wide performance, look at the highlights in their main business segments, and then this is key, unpack that updated guidance they gave.
Yeah, and they actually set that tone themselves, didn't they?
How so?
Well, the CFO mentioned right at the start that the prepared remarks were deliberately shorter this time, streamlined. The idea was to get through the published numbers faster and leave more time for the Q&A, for the deeper discussion.
Ah, okay, so signals a focus on efficiency.
Exactly. It tells you they expect people, analysts and you listening, to be thinking about the why behind the numbers, the implications, not just reading a list of figures they already put out.
Makes sense.
Yeah.
Okay, so let's follow their lead and get straight to it. Those big headline numbers. JPMorgan reported net income of $14.4 billion.
Huge number.
It is.
Mm-hmm.
And that translated to earnings per share of $5.70, generating a return on common equity ROC of 20%.
And that 20% ROC, that's really something. But maybe the bigger story this quarter is the revenue number, $47.1 billion.
Which was up 9% compared to last year. Right?
Yep, 9% year on year. For a company, this massive 9% growth is pretty impressive. And it's interesting how they got there. It was mostly driven by higher markets revenue, but you also had higher fees coming in from asset management, investment banking, payments.
So kind of firing on multiple cylinders, not just one thing carrying the load?
That's the bird's eye view, yeah. But if you dig down just a bit, there's an important point about net interest income, the NII.
Okay.
They did see NII go up because the balance sheet grew, the mix changed, but that gain was basically canceled out by the impact of lower interest rates.
Wait, okay, let's pause on that. NII offset. That sounds a bit technical. What does that really mean for someone listening? Lower rates sound good for borrowers, maybe bad for bank profits.
It means it's a tougher environment for their basic lending business profit. See, they were growing their loans, right? Which normally means more interest income. But the lower rates across the board kind of squeeze the margin they make on that money, the difference between what they pay for deposits and what they earn on loans.
Ah, gotcha.
So yeah, the balance sheet got bigger, but the profit on that extra size was tighter. So it really fell to the fees and the market side, the non-interest stuff, to kind of rescue that overall revenue growth number.
Right. Puts a lot of weight on the capital markets performance then.
Right.
Okay, let's flip to the other side. Costs. Expenses came in at $24.3 billion. That's up 8% year on year.
Yeah, and the official line was, higher volumes, costs related to generating that higher revenue.
Standard explanation.
Pretty standard, yeah. But look, when costs are up 8% and revenue is up 9%, it does make you wonder, right? Are they really keeping a tight lid on costs? Or is this just, the price you pay to grow in this environment? They're clearly investing, people, tech, trying to grab that revenue. But it doesn't leave a lot of room for the margins to expand on the cost side itself.
Right. An expensive way to grow, maybe.
Nah.
Okay, what about credit quality? Credit costs totaled $3.4 billion. That includes $2.6 billion in actual net charge-offs, plus they built reserves by about $810 million. But there was something a bit unusual tucked away in there, wasn't there?
Yes, this is where it gets interesting. They specifically called out that wholesale charge-offs, so think business loans, not credit cards, were slightly elevated.
Okay, why?
The reason given was, and I'm quoting here, a couple of instances of apparent fraud in certain secured lending facilities.
Ooh.
Fraud. A couple of instances driving up charge-offs noticeably at the biggest bank in the U.S. That sounds kind of significant.
It does sound that way, yeah. Does it point to a bigger problem in business lending?
Well, according to them, no. They were really quick to frame it as idiosyncratic, just a couple of specific, unfortunate situations tied to those particular loans, not a sign of weakness in the whole corporate credit book. They said the rest of the credit performance, consumer and wholesale, was basically right where they expected it.
Okay.
But it's definitely a reminder, isn't it? Even with all the controls, lending has risks. Operational risks, fraud risks, especially in those more specialized areas.
Fair point. Okay, one last thing on the overall picture before we dive into the segments. Capital. Their CET1 ratio, that's the Common Equity Tier 1, kind of a core measure of their financial strength.
Yeah, the regulatory buffer.
Right. It ended the quarter at 14.8%, which is actually down 30 basis points from the previous quarter.
And that dip that's important for you listening to notice, it wasn't just random shrinkage. It was driven by higher risk-weighted assets, meaning they put more capital to work, mainly through more wholesale lending and more markets activity. This is them making a choice. They're using some of that excess capital buffer they had to actually fund the growth we've been talking about. It shows they're confident, right? Leaning into that risk-reward idea, believing the revenue they expect to get justifies using up a bit of that cushion.
Okay. Deploying capital, betting on the future. So the big picture is strong, but like you said, you got to look under the hood. Where did those big revenue gains actually come from?
Exactly.
Let's move into segment 2. Performance across the main divisions. Where do we start?
Let's start with the biggest reach, lowest risk perhaps, consumer and community banking, CCB. They brought in $5 billion in net income. Revenue was $19.5 billion, and that was up 9% year-on-year too. The big story here, consumer resilience.
Right. Given their size, their data is almost like a proxy for the U.S. consumer's health. What do they actually say about how people are doing?
The internal data, they said, clearly shows consumers, small businesses, they remain resilient. And the really interesting bit, maybe surprising to some, was that their credit metrics, things like early delinquencies, weren't just stable, they were actually running slightly better than expected.
Wow. That's a pretty big statement about the economy, isn't it? Despite everything, inflation, rates, the average person is holding up okay, maybe better than forecast.
Seems that way based on their massive customer base. Yeah, it provides a really solid foundation for the whole bank.
And strategically, they mentioned holding on to their #1 spot in retail deposits again, 5th year running. But they also had a big win on the card side.
They did. They highlighted the recent refresh of the Sapphire credit card, called it a major success. Apparently led to the best year ever for signing up new Sapphire accounts.
Huh. That's a competitive space.
It really is. And winning there is expensive, no doubt, but it pays off long term. Customer loyalty, payment volumes. It ties back to why they're okay with that 8% expense growth we talked about. They're spending money where they think it counts.
Got it. Okay, let's shift gears to the big institutional side. The Corporate and Investment Bank, CIB. This is where the revenue really topped, right?
Absolutely popped. Net income was $6.9 billion. Revenue hit $19.9 billion. That's up a huge 17% year-on-year.
17%.
Yeah.
So what drove that?
Well, the institutional clients are back in action. Investment banking fees jumped 16% year-on-year. They pointed to a strong pickup in activity, especially in equity underwriting, lots of IPOs happening. And they said the pipeline looks robust, the outlook is upbeat. So they sound pretty confident about continued deal-making.
Okay, deals are back. But what about the trading side? Markets. That often drives these big swings.
It definitely did this quarter. Fixed income trading was up a very strong 21% year-on-year. Rates, credit, securitized products, all doing well.
21% is strong.
It is. But then you look at equities trading, up 33% year-on-year.
33%. That's kind of staggering.
It really is staggering. And it tells you a couple of things. One, obviously market volatility creates chances for trading desks. But two, they specifically said that huge gain was driven by robust client activity with, quote, notable outperformance in prime services.
Prime services.
Yeah.
That's the part that deals with hedge funds, right?
Exactly. Financing, clearing trades, all the sophisticated stuff hedge funds need.
So if prime services did exceptionally well, it suggests the big professional investors, the hedge funds, they were really active this quarter, making big moves.
That's the implication, yeah. They were likely taking advantage of market swings, maybe repositioning significantly, and it shows JPMorgan is the bank they turn to when they need to do that, capturing a big slice of that very profitable business.
Okay, so CIB was clearly on fire. Let's round out the business units with Asset and Wealth Management, AWM. How did they do?
Also very strong. Net income there was $1.7 billion, and they hit record revenue, $6.1 billion, which was up 12% year-on-year.
Record revenue. Was that just markets going up?
Markets going up definitely helped, sure. Higher average market levels boost assets. But they stressed the driver was growth in management fees, and that came from strong net inflows.
Ah, new money coming in.
A lot of it. They pulled in $72 billion in long-term net inflows just in Q3. That's $72 billion of client money actively choosing JPMorgan over competitors this quarter.
$72 billion. That shows some serious trust in the franchise.
It really does. Their assets under management, AUM, hit $4.6 trillion, up 18%. Total client assets reached $6.8 trillion, up 20% year on year. Just enormous scale and still growing fast.
Incredible momentum.
And just to wrap up the segments, the corporate division, sort of the central overhead and treasury functions, reported net income of $825 million on revenue of $1.7 billion. So solid performance across the board.
Okay, that covers the segments. Now let's get to segment 3. The updated guidance. This is always critical, right? What do the next few months look like? And crucially, what are they signaling about next year, 2026?
Right. The CFO gave some specific numbers for Q4 2025.
Which we expect.
They're guiding for NIX markets, that's the non-interest expense tied to markets, to be around $23.5 billion. Total net interest income, NII, holding steady around $25 billion. And importantly, adjusted expense for Q4 is expected to be about $24.5 billion.
Okay, $24.5 billion for Q4 expense. If you annualize that, or rather add it to the first 3 quarters, what does that imply for the full year 2025?
It implies a full-year expense number of roughly $95.9 billion. And this brings us back to that investment theme again.
Because that's higher than maybe people expected earlier in the year.
Exactly. They confirmed that increase in the full-year expense outlook is directly because of the stronger revenue environment. They're spending more because they're doing more business, basically. Servicing higher volumes, investing for more growth.
Makes sense. Did they update anything else for 2025?
Yeah, a positive one on credit. They now expect the full-year 2025 card net charge-off rate to be lower, around 3.3%. They cited those favorable delinquency trends and the consumer resilience we talked about.
So they feel pretty good about consumers heading into the holidays and year-end.
Seems like it. But then came the really interesting part. The first look into 2026.
Yeah, this is where everyone leans in. What did they say?
They gave a preliminary central case for NIX markets again, that markets-related expense line for 2026. Approximately $95 billion.
$95 billion for NIX markets in 26. Even with caveats, putting a number out there that big signals they expect markets activity to stay pretty elevated, doesn't it?
It absolutely does. They did stress, it's preliminary, the full budget process isn't done yet, but it gives analysts a concrete number to start building into their model.
Okay, but what about total expenses for 2026? That's always a huge focus. Did they give a number for that?
No, not a formal outlook number for total 2026 expense, but they gave a very, very strong hint.
Oh, what kind of hint?
Well, they talked about the current consensus estimate among analysts for 2026 expenses. It's been hovering around $100 billion. The CFO said quite directly that when they look at the Q4 expense run rate and adjust it for normal seasonality for labor inflation, that $100 billion consensus number does look a little bit low.
Hold on. A little bit low. Isn't that classic management speak for we're going to spend way more than you think, but we want to set the bar low now? What's the real message there?
Well, you're right to be skeptical. There's always an element of managing expectations, but I think there's genuine substance here too. They know they have to keep investing heavily to stay ahead, right? Paying top dollar for talent, pouring money into technology to handle all this trading and payments volume, add in sticky inflation for wages. It strongly suggests their own internal budget is going to land noticeably higher than $100 billion. So yeah, partly managing expectations, but also signaling that the cost of competing and winning is going up. They don't want analysts to be shocked later.
So the takeaway is expect a bigger expense number for 2026 when they give the formal guidance.
That seems to be the clear message, yes. They said the formal outlook for NII, expense, and the card rate for 2026 will come with the Q4 earnings results, and then more discussion at their company update event in February. They're pacing it out.
Got it. Okay, well, that brings us pretty much to the end of our deep dives into these prepared remarks. Wrapping it all up, it feels like a quarter defined by really strong revenue growth, particularly in CIB markets and banking, but underpinned by that surprisingly solid consumer picture.
Yeah, and leveraging their scale, putting that capital to work like we discussed, and just showing market leadership across the board.
Yep.
And, thinking about that connection between revenue and expense, it brings up a final thought, maybe something for you listening to ponder. The bank kept saying, effectively, our expenses are higher because our revenue is stronger. It makes you ask, in these really strong growth periods, can these massive banks ever really separate spending from revenue? Or is that constant aggressive investment in tech, people, capacity, and the expense that comes with it just fundamentally the cost of staying dominant in today's financial world? Is decoupling even possible when you're winning?
That's a great question. Can growth ever be truly efficient at this scale, or does winning just mean outspending? Something to chew on. Well, thank you for joining us for this deep dive into JP Morgan's Q3 remarks. We hope this shortcut gives you the insight you need. We'll catch you next time.